All right, so exam 2, we're covering chapters 1 through 8, plus that digital property chapter that we had before. 10 true false, 10 matching. So similar to the matching you saw in exam 1, match those definitions to the word. 10 short answer, 1 infrequently traded stock, and that's the idea that somebody is going to have a stock that wasn't traded the day they died. Some stocks aren't traded every single day. We do that counting. The tricky part there is it's opposite. Days after with the price before, the days before with the price after, and then divided by the total days. All right, so the goals of estate planning, really we don't want to leave chaos behind. You want to have these effective and efficient transfers, plus you want to take into account the client's healthcare decisions. So effective, it goes to the person they want. Efficient, it's also the most tax effective way, meaning I'm maximizing what I give my loved ones and minimizing what I give the government or the courts. Some of those definitions you might see on the matching. Person that died for the decedent, donor, donee for gifting, transferor, transferee for transfers. Principal creates a power of attorney. We saw something similar for the creation of a trust, the grantor, creator, settlor. Multiple names for the same thing. Agent receives that power of attorney. So the principal creates a power of attorney. This could be healthcare, this could be for property, and then the agent is the one that now has that power. Executor versus administrator, they are helping with the probate process. Executor is somebody that you can name in the will. Administrator is appointed by the court if you either didn't have a will, failed to name an executor, or the executor / contingent executors that you did name in the will are unable or unwilling to serve. The big difference there, the executor is probably going to be a loved one. The administrator is going to be an attorney that does this for a living. A lot of times you want to have two, same thing for trust. You want to have a loved one as an executor, a loved one as a trustee, plus somebody that is professional, knows how to do those different things. Exchange, I trade my boat for a car. Installment sale, thinking I'm buying a car from a car dealership. And you can do this with that arm's length transaction with a stranger or with a loved one. With the loved one, we had the self-canceling installment note and we had the private annuity, the idea that they were going to continue to pay you for a life. Probate, we're retitling assets, and we want to avoid this as much as possible with those other ways that we can pass assets on to our loved ones, either gifting during life, the way we title them. Beneficiary designations would be the big one for financial planners. Through trusts, permanent provision, we're giving that window of opportunity to take what I just put in. So Merry Christmas, here's a card. You have 30 days to take these dollars out. That lets me use the annual exclusion. Follow up on that crummy provision is that 5 and 5 lapse. So if I have multiple beneficiaries in the same trust where I gave them all this crummy provision, they're making gifts to each other if they let that power lapse. The 5 and 5 is the lesser of 5% of the trust assets prior to my gift, or $5,000. They're gifting each other whatever the difference is of that. Easy way to avoid that, just create separate trusts, and then you don't have to go through this every year when you put these in. It's not going to cost much more. You'll probably pay for itself, because with one trust with 3 beneficiaries, all equal in it, they are getting the exact same terms, the exact same maybe ascertainable standard of health, education, maintenance, and support. So the language would be the same. The attorney just has to make 2 more, or however many he would want in it, and just change the name. That's not going to cost much more, so you should save that money in 1 or 2 years. Equitable ownership would be the beneficiary of that trust. They receive the right to enjoy it. They may not be able to demand it for certain things, depending on the strings you put in there, but they are the ones that get to enjoy that property asset, whatever it is. We looked at some different valuation discounts, lack of marketability, key person, the ability basically to turn it into cash for the same amount that it would be as if I owned it versus whoever I gave it to. All right, places. Domicile is where you live, situs is where the property lives. If we have property in another situs, another state, I have to go through ancillary probate. That's going to increase the costs of probate itself. Because I have to pay the court fees, I probably have to hire an attorney that's licensed in that specific state to go through everything. If we don't plan, the big one is chaos. But while you're alive, you don't have the liquidity, you don't have the long-term care, the short-term care to help you out in some sort of incapacity. You get hit by a bus, you're in the hospital, what's going to happen with your bills, with your utilities, all these things that need to keep getting paid. We talked about the Terry Schiavo case. So client's family is unaware for your preferences. Terry's husband, after a reasonable amount of time, said, let's pull the plug. Terry was in a coma. Her parents were like, no, she's going to wake up. Years and years later, with the cost, with the chaos, with these two loved ones, both wanting the best for Terry, for themselves, are trying to help, but because she didn't have that living will outlining exactly what she would want to have happened, they had to go through courts, they had to go through a lot of negative things that could have been avoided. Property transfer objectives may go unfulfilled, taxes excessive, transfer costs excessive, so all these things that we could have planned for. With the property transfer objectives going unfulfilled, remember we had that idea of intestacy, where you die without a will, or without a will that covered everything. Easy fix to that, have a residuary clause in your will. And that covers the mustard in your refrigerator, all the different things that you're not going to list out individually. The liquidity needs for your family. Young family starting out, insurance is a great way to provide for those needs for the family, and you can put it into a trust to make sure that your children from that marriage or from a previous marriage are still taken care of. Should your spouse remarry and have more children, you don't want that Cinderella situation for your darling daughter. So when I'm creating an estate plan for someone, if I'm their financial planner, I've already got this stuff. And some comprehensive financial planning firms will also offer estate planning and tax planning. They'll have CPAs, they'll have attorneys within that office. Or they might refer it out to somebody. They probably have a relationship with some CPA firm and they've got it good at that firm because they're going to have all this information that you would get as a financial planner. So all the financial statements, assets and liabilities, so net worth, any health documents. This can be more for the attorney. The CPA doesn't care about that. But we want to know what health insurance they might have, what long-term care policies, anything like that that might come into play. Annuities, similar to pension, except this one I buy with money rather than my service time at a company. Wills and trusts, I want those in a place that can't easily be destroyed. I probably have multiple copies, maybe one at the attorney's office, maybe one virtually somewhere in the cloud, maybe one at home, because a will is very easy to revoke. I rip it, house catches on fire, I have no will. Same thing for trusts. If it's not available somewhere, it's going to be difficult. We also talked about those digital assets. So everything you own on your laptop, all those digital files, the Word documents, the PDFs, the things you might have in the cloud, the songs, maybe social media, maybe it's monetized. What's going to happen to all that? So planning for those things and giving people the ability to access them. Power of attorney, general power of attorney. We'll talk in a second in the slide where we really don't want to have a general power of attorney. We want it to be more specific. So they can just sign the closing documents on my home sale while I'm out of the country. Or they can pay my rent, they can do different things. General power of attorney, they can take out loans in my name, they can sell all my assets, they can take all the dollars out, pay off their own debts, go gambling, do whatever they wanted. I want the previously filed returns, because remember, those gift taxes are gonna go through until my death, and they're gonna be combined with what right now is that 13.99 million. So I'm probably never gonna pay gift tax while I'm alive. It wouldn't hit unless I went over whatever the amount is. And remember, we have that sunset provision in 2026 where that applicable credit, where we had that 13.99, is going to drop down to 2017, 2018 levels to about $7 million now. Those gifts we made during 2018 through 2025, they'll still count towards those specific years' numbers. There will likely be some sort of legislative action that will raise that up from 5 million and keep it going where it's at. But I need to know what gift taxes they might have paid during their life, because that's going to impact the estate taxes that might be paid. Remember, only 1 to 2% of estates are actually going to have to pay taxes. What they've already transferred, so paid for daughter's wedding, that was expensive, didn't give son anything. So considerations for when I do make the will, maybe I want to make it equitable, or maybe the client wants to make it more equitable and give son whatever amount out of the estate and daughter less because already gave for the wedding. I talked about the testate versus intestate. Every state has their own laws of intestacy. So everybody has an estate plan. It's just the plan that the state has for you. So if you want everything to go to spouse, cool, that's where it's going. All your stuff will, depending on the state, almost always goes to spouse if you're married. Then likely to children, then to parents. Depending on each specific state's setup, they are going to have you give to different family members, and it's going to be 100%. So as soon as they find somebody that matches that, do you have a spouse? Yes. Cool, 100%. Do you have a spouse? No. Okay, do you have children? Yes, there's 5 children. Each of them gets a fifth. So it could be split up like that, but then you've got those kids arguing over, well, I want the house, I want the 401k, I want the whatever asset. So plans are better. These different estate planning documents, the will, we want the statutory will, not the joint will, not the sweetheart will. Joint will, I'm locked into it. I can't change it. We made this will 20 years ago, me and my spouse, and now we divorced long ago, one passes away, we have more kids, all these different things happen. So you want the statutory will, which is just for me. I can change it, I can revoke it, I can do whatever I want while I'm alive. Side instruction letters, these are not legally binding. It's what music do I want to play at my funeral? How do I want to be buried? And some of that I can prepay, leave my grieving widow, children, to not have to deal with where does Rich want to be buried? How does he want to be buried? Does he want to be cremated? Which coffin, which casket should I choose? Where should the ceremony be? All these different things that I could have planned ahead and prepaid so that there's less of that for them. Side letter of instruction, I can set aside money for these things and say this is what I want to have happen, but loved ones don't have to follow any of those. I mentioned the powers of attorney for property. Similar idea with powers of attorney for healthcare. Durable, it lasts until I actively revoke it, and I can make either of these spring, whether it's for financial or health. It springs into existence. They don't have the power until a specific event happens. I'm incapacitated, I'm out of the country, something like that. And I can always end that power for the agent. But I have to reasonably notify the bank, notify whoever might, in good faith, think Jeff has this power of attorney to act on behalf of Rich. He does this action. The bank doesn't realize that I ended that power. So I have to put everybody on notice that that's happened, that might be impacted. living will, what do I want to have happen if I'm in a coma? How long do I want to have those machines plugged to me? Do I want specific machines and not others? Do I want a specific time period, a specific, I show this sign of life, there's mental activity, there's something going on, or do I want it more, keep me on forever? Do not resuscitate orders. You'll see those bracelets, people that don't want to have CPR. They don't want the pain of going through that. So you'll see this in nursing homes. When you are frail, it's going to be more painful surviving afterwards. Maybe you're already in a lot of pain. So the do not resuscitate orders lets people know. If we have a will, I'm able to choose a executor. I can, if I have children, figure out a guardian for them. We're going to talk about creating a trust for that, because if sister is the guardian of my children and she gets in a wreck, she gets a lawsuit filed against her, she goes through a divorce, if I had just given her assets to raise my child, and she could be a wonderful person who wants to do the best for the kids, but the divorce, the court is going to view those as community assets or her assets, depending on the state she's living in. So I want to set up a trust, and I want to make sure my children are cared for, even if I am setting up that guardianship. Additional considerations for the guardianship: communicate with the person. So if I've never had a conversation with my sister about raising my children, she might not want to do it, or maybe hold a little bit of a grudge and carry that on the kid. So I want to talk to people. I want the kids to know, hey, how old they are. If something should happen to me, you'll go live with Aunt Christine or whoever. Without the will, I can't create this. Instead, the court is going to appoint a guardian ad litem, somebody they feel, maybe it's foster care, maybe it's a family member. They tend to try to keep children with their same family, but somebody would have to be able to raise those children. Transfers of assets to charity. None of the state and intestacy schemes give anything to charity, unless you count the state itself as a charity. They'll try to go through that list of people, blood related to you, and if they can't find anyone, they give it to themselves. Most likely they're going to find somebody, but it may not be who you want or split up the way you want. We can also give as much as we want to spouse, so we're able to use unlimited unmarital deduction, which, if you had a spouse, would go 100% to them anyway, under the intestacy schemes. Disinheritance or reduced amount. So the example I gave earlier, let's say me and spouse die in a car accident, 2 children, we already provided heavily for daughter, for college, for marriage, whatever, and son not as much. So if I were writing a will, I might want to give more to son than to daughter, because daughter's already been provided for. But if we're going through that state intestacy scheme, it's going to be split evenly between the two. Or maybe son is a jerk, son has stolen from me, done something, and I don't want to give son anything. I don't want to be able to contest it, so clear language, I leave nothing to Joey. I could go into because Joey is a jerk, because of this, this, and that, or I can just say, and I leave nothing to Joey. Now Joey can't say I forgot about it. Minimizing the estate tax burden, because I'm able to take advantage of the unlimited marital, unlimited charitable deductions. I can use the portability feature. Any amount that I don't use for my $13.99 million, should I die this year, could go to spouse. And then they pay less in taxes when they pass away. Directing where the tax burden should be paid. The executor is going to be able to make some decisions on that, but let's say your taxable account, your brokerage account, your retirement accounts, everything else where there's cash, your bank account, all have beneficiary designations. It makes it really hard for the executor to pay any taxes, should they be owed. And this also goes for the cost of probate itself, so where are the court costs going to come from? Where is paying the attorney, paying the cost of going through another state, all these different things to continue to maybe keep property insured, to keep property secured, which I would have to do as an executor. Joey can still contest the will. I said I leave nothing to Joey because he's a jerk. Joey can still contest it and say that for one of those reasons I gave in class, I was under duress. Somebody had a gun to my head, somebody manipulated me. I didn't realize what I was doing, or maybe I was incompetent to make a will at the time I made this new will. Low standard of competence to create a will. I just have to know who I am, who my heirs are likely to be, and my stuff. Court can invalidate certain restrictions on a will without invalidating the entire will. So for a will to be valid, I need an introductory and declaration clause saying, I'm Rich Stebbins, I declare this to be my last will and testament. I have to give stuff away, and I have to have it signed. So that could be done very easily. Just those few clauses, and I have a valid will. I'll even have to have that self-proving affidavit where the notary comes in and says, yes, I saw these two witnesses sign, plus I saw Rich sign. So very basic, but I can put more and more things in there. If I were to say I leave $10,000 to Joey to be used for education, the court's going to say, cool, $10,000 to Joey, and they'll cross out the line to be used for education. Joey can do whatever he wants with those dollars. Automatic transfers, that's that beneficiary designation. They're always going to trump what's in the will. If I say I leave my 401k account to Joey in the will, but my beneficiary designation is to Susie, it's going to Susie. It doesn't matter that if I made the will 2 hours before I passed away and that beneficiary designation was from 5 years ago. Poorly drafted may be found to be invalid. Very easy to have a valid will. We saw those few clauses were all that were needed. You all created a valid will, or almost all of you created a valid will with the signatures that you needed to make it valid. That part's not difficult. The other part was testator's wishes may not be clearly understood. So there are a few things where something might conflict. Some of you use boilerplate language, and one section would conflict with the one that you wrote earlier. So just being as clear as possible in the language in it. Talked about it is easy to be competent to make it, how easy it is to revoke a will, and some of these different clauses. So introductory declaration requests, ideally a residuary, so there's no intestacy. Yes?
Is there any way we could overlap the different chapters? Because we could watch this
Sure.
with the whole video.
Yeah, where do you want to start?
Just whatever we weren't tested on last time. Thank you.
Yeah. Property. I think we were at probate, right? For the new stuff?
I think so.
Yeah. Like I said, the point of probate is to retitle everything that's not being retitled through one of those other ways. Beneficiary designation, titling, and trust. If you've created a revocable trust, it becomes irrevocable when you die. So those things are going where you want them. Everything else has to go through probate, which is this time-consuming process. So you see the pluses there, advantages, it's retitling the asset, and creditors are put on notice. It's public. Public is negative, it costs money, and it costs time. So we've got the negatives and positives of probate. If I'm the executor, I get all your stuff, figure out what you own. I want to know assets and liabilities, so I know what creditors need to be paid. And only after I pay the creditors can I start distributing assets to loved ones. And that includes what taxes might be owed. Redemption, it's extinction. Redemption, extinction, I gave a Camaro to Susie, but now I don't have the Camaro. So in the will I said this Camaro goes to Susie, and when I actually passed away, I don't have the Camaro anymore, I bought a Mustang. Susie doesn't get the Mustang because I said Camaro. You use that codicil to switch that over without writing a new will. Not enough assets to satisfy all requests. Abatement. The flood water is abated. We're going to reduce it to the amount that is available. And try to fulfill the deceased's wishes as best as we can. Alternatives, we talked about that. Beneficiary designation are different types of titling with really only these tenancy by the entirety and joint tenancy by survivorship not having to go through probate. Tenancy by the entirety only for married couples, and we have that deemed 50% rule. Joint tenancy with right of survivorship doesn't have to be married, could be 5 people, could be however many we want, just 2+. Trusts, revocable, those I can change anytime while I'm alive. Irrevocable, I would have to get every single potential beneficiary from the will or from the trust to say, yes, you can bust this trust. So we treat an irrevocable as if I'm not ever going to be able to do that. Revocable becomes irrevocable when I die. Irrevocable now can no longer be busted because grantor me has passed away. Now we'll talk about our digital assets and different ways to manage those, making sure that somebody knows the password, somebody can get in. If we have something that produces income, so you monetized your TikTok or your whatever account, what happens to that? Does that just die with you? If we let a business own it, create an LLC, it owns that, we can live it on in perpetuity. Other things you want to have stuff done with those digital assets. And then gifting. So gifting, there are at least 2 parties. The person with the stuff and whoever they give it to. I can gift to a charity if I want. So I have to know what I'm doing, intend to do it, and it's voluntary. The recipient, after watching the baby, they have to be competent to receive it. Take delivery, and we have that mailbox rule where it's assumed it's theirs. With gifting, we have the idea of there was some sort of transfer. I gave them something. It could be cash, it could be a car, whatever, and without full consideration. If there's partial consideration, you can have a partial gift, partial sale. I sold the $20,000 car for $5,000. I made a gift of $15,000. Consideration, we assume if it's strangers, it's this arm's length transaction and I got the best price I could, they got the best price they could. Maybe I got the better end of the deal, maybe they did, but either way we were trying our best. So fair consideration, we tried. If I have a gift of present interest, I can use my annual exclusion. So I have up to $19,000 for the year 2025 to give to every single person in the world. I can give $19,000 to every single person and not have to file a gift tax return, not pay gift taxes. This is cumulative. It's all the gifts for the year. Next year it starts over. To a citizen spouse, I've got unlimited. I'm never paying gift tax on that. To a non-citizen, this year I have up to $190,000. If I'm married, we can split gifts. Spouse and I can split gifts, meaning now instead of me having 19 that I can give to every individual, I have 38 that I can give to every individual. But spouse is sharing that. It's a combined, me and spouse together can give 38 to every individual on the planet. It is for the entire year, and we're going to have to do it again each year. Present interest, you've got it in your hot little hands and you can enjoy it. Talk about the mailbox rule, we'll throw that exception. Future interest, you might never receive it, or I have the ability to take it away. I mentioned the crummy provision earlier. That was that window of opportunity that the beneficiary in a trust had to take this contribution. I want it to be just one person. I want to create separate trusts so I don't have to go through this 5 and 5 lapse rule where they make gifts to each other. So if I create those separate trusts, I give you Merry Christmas, I put $10,000 into this trust for you that comes with the strings that I wanted, and you have 30 days to take it out if you would like to. If they don't take it out, cool. If they do take it out, either way I'm still using my annual exclusion, so I'm not taxed on it. But if they do take it out, I'm probably not going to put additional contributions into that. Imputed loans. So I want to help out a loved one. I lend them money at a very low interest rate. We're going to look each month, whatever month it is that we made the loan, to the applicable federal rate to see what that is. And then we're going to see if it's counted as below market. So if I lend you less than $10,000, cool. And I could do this with spouse. Like I could lend son $10,000 and wife could lend son $10,000, and we're not worried about it being over $10,000 because we're two separate people. We don't have to worry about imputed interest. We can do it at 0%. We can do it at 1%, whatever. 10,000 to 100,000. Now we're looking at their net investment income. If it's less than 1,000, imputed interest 0. If it is over, we are going to look at that standard rate. Over 100,000, applicable federal rate. You won't have to calculate that, but maybe know the different brackets. Now, in the examples there, with the dollars in it, you don't have to calculate here. Not a gift. These are some sort of contribution to something else. So to a political organization, if I give it to Republican, Independent, Democrat Party, cool, that is not going to be counted as a gift. But if I give it to a specific candidate, then I am making a gift to that candidate. Qualified transfers, those were where I was paying tuition for somebody else, but I pay it directly to the educational institution. So direct to the institution, not to the individual. Same thing for medical payments. Directly to the medical care provider rather than the individual. Payments for support and divorcing spouses. Court is requiring you to do this, so I have to pay child support, I have to pay alimony. It's not a gift. The court says I have to make those payments. The division of assets when we do divorce, I didn't just gift spouse my Roth IRA, they took it through the divorce proceedings. Transfers and business setting, so you're getting that from the services you provide. You work at a job, they give you a paycheck, maybe there's a bonus at the end of the year, maybe there's a company raffle, maybe there's a company contest where you win it. It's not a gift, it's still part of your services. Maybe there's a company retreat, you get a trip to Hawaii, still not a gift, it's all part of you being an employee there. Gifts to spouses and charities, unlimited. Gift to spouse, I have this idea that the IRS views this as a single taxable entity. So I can give as much as I want to spouse, non-citizen spouse 190, because the idea is they might go to their home country and never pay taxes here. For both citizens, IRS is like, well, we'll get it eventually. We'll get our cut. Charitable gifts, and this goes into some gifting strategy. If I have a highly appreciated asset, I can give this to a charity. And it's a gift, but it's a donation. I can deduct what I'm giving to the charities, and we'll go into charitable deductions and those different types of companies. I think next chapter when we come back, and your work day on Friday was coming up with the charity that you wanted to give to, finding one good one and one bad one. So hopefully you've done that. But highly appreciated. I did pay the capital gains, and I deducted what I gave. Direct gifts. Here's this stuff. Appreciating property. I gift it before it appreciates. It's going to appreciate over time, and now I got all that appreciation out of my estate. So a lot of these we're looking at as a way to not pay taxes, and that's only 1% or so of the estates. So more is we want to give it to where we want it to go. Gifts to minors may need trust or custodial accounts. We'll look at the 2503B and 2503C, where I set up a trust for a minor. With the B, they're getting those dollars throughout. With the C, I can let it accumulate, depending on how I set it up. So I want to give different loved ones and a charity a gift. I have these different assets that I can give. So oldest person, I want to give them an income producing thing. That way they've got steady dollars to pay for their retirement. If it requires some sort of management, maybe I want to put it in a trust or set it up so that they're not having to deal with the day-to-day if they're somehow unable to. If it is a high income producing property or there's going to be more future appreciation, I want the youngest person, the person in the lowest tax bracket, to have that. Charities, something that's highly appreciated. And art is nice here because it also comes with they're going to protect it. So I have this valuable thing, I can even lend it or donate it to a museum. They're going to have the security and people are going to be able to enjoy it. And maybe I've got my name on it, so I've got that legacy that I want. This idea of property that is less than fair market value, that's where we get double basis. So I bought this thing for $50,000, and when I gifted it to you, it was worth $20,000. So fair market value when I give it to you is $20,000. You now have double basis. You don't know what your basis will be until somehow you are divested of that asset. You gift it to somebody, or it goes by will. So your basis, should you sell it for more than $50,000, is $50,000. You're going to pay capital gains on the difference between whatever it went up to. So let's say I bought some art for $50,000, and it's lovely art, but then news comes out that this artist is a fraud and something has gone wrong with it, so now it drops down to $20,000. You get it for $20,000, but it goes back up because that artist died and there's all this controversy around it. So now it's worth $60,000. Your basis is going to be $60,000, the higher of the two. If instead it continues to go down, you sell it for $10,000, your basis is $20,000, and you have capital loss. Anywhere in between, it's a wash. There's no capital gain or loss. So better for this thing that's less than my original basis would be, if I want to give you something, just sell it, take the loss myself, and then gift you the cash, or just keep it myself. Big picture for estate taxes. Gross estate is everything that you own or had an interest in. And we saw that 3-year clawback rule. We saw a bunch of different internal revenue codes that define specific types of assets. Big picture, it's everything in the kitchen sink, everything you own or have control over. That danger of having the general power of attorney over somebody else's assets is, I had it for Bezos, all of his assets. Now I definitely have a taxable estate, but I can't give away his stuff. That power dies with me, but because I died holding the power, it's included. So gross estate, everything you own or had any sort of power over. If I can change the beneficiary on a life insurance policy, if I could change a trust, all those revocable trusts, they're going to be part of my gross estate. Things we can take off, last medical, unless I can't claim it on, and the executor is going to make this choice, unless it's claimed on the decedent's final income tax return. Probably better there, because the estate is probably not taxable. So I want to be able to leave more things to loved ones. The administrative expenses are the executor or the court-appointed administrator making everything go through probate, distributing assets, putting everybody on notice, insuring the homes, the different things that could catch on fire, which if I didn't do that, I'd be personally liable, but I don't have to keep it insured out of my own pocket. Last, funeral expenses, any debts that have to get paid out. So all those, credit card, maybe you've got your mortgage, maybe you don't. And you can give a home with a mortgage attached to it. It doesn't necessarily have to be paid by the estate. But whatever debts we've got out there, the estate is paying, that reduces our gross estate. Then we have as much as we want to give to charity, as much as we want to give to spouse. So unlimited for both of those. If we paid state death taxes, take that out, and then we get to the taxable estate. The taxable estate is probably going to be under the 13.99 million. So 99% of the estates are going to not be taxable. We still have to file, otherwise we're running those penalties. Valuation of all these assets. Almost all the time it's going to be fair market value on the date of death. The exception would be alternate valuation date. I can only use the alternate valuation date if I have a taxable estate. If it's not taxable, so 99% of estates won't be taxable, I can't use the alternate valuation date. If it is taxable, it also has to be artificially high right now. So if I wait 6 months, other than what I sell in the interim, other than depreciating assets, depreciating wasting assets that would just naturally be worth less, the depreciating would be fair market value on date of death. The house that I sold 3 months later would be at that value. Everything else that we had would be at that 6 months from date of death value. With this alternate valuation date, and I don't have a taxable estate, I don't want to do that. I would love to have everything artificially high. That way my loved ones inherit at a higher basis. Different things that I need to appraise: real estate, art, antiques, things like that, jewelry, where somebody has to come in and say, this is what this asset is worth. And I want to have that documented. I want that paperwork to go in with the estate tax return. Now, we talked about our different ways that we can use valuation discounts. The minority discount, that would be for that family limited partnership where I'm the general partner, I only own 1%, but over the last 10 years, I've been giving away these limited partner shares where those limited partners now own 99%. Susie owns 25% of the company, but there's no value to it, or not very much, because they cannot make any business decisions. They can't demand an income, they can't hire, fire, they can't do anything. I'm the general partner, I only own 1%. This just lets me slowly give it away. If I were to die holding that 25% limited partnership, I could use this minority discount, lack of marketability discount as well, where who's going to buy this 25% of a company when they can't do anything with it? It would be useless until the general partner passes away. Blockage, I give you a big chunk of a company, and if you were to try to sell it all at once, supply and demand, it's going to go down in price. Key person, I'm the one that runs the plumbing company. My face is on the side. I'm the licensed master plumber. All my loved ones are really getting is my fleet of vans, the warehouse with some tools and equipment and stuff, but they're not going to be able to continue to run the business. This is that math you're going to have to do, where I have the infrequently traded stock. I pass away on a Wednesday. It wasn't traded Wednesday. The last time it was traded was Monday. The next time after I die is the following Monday. Trick there, don't count the weekends, don't count holidays. So if the S&P 500 wasn't trading that day, I don't count that day. So we're going opposite. The price, and it's the average of the high and low. Number of days between decedent's date of death and first preceding trade, and then opposite on the other side. So that's the trick on this. The thing people mess up is price before times days after, price after times days before. Add those together and then divide by the total number of days. So we did a couple of those in class. Arm's length transaction is what we talk about when you go buy something from somebody in Facebook Marketplace or at a swap meet or whatever, or you go to the grocery store, you buy a loaf of bread. It's an arm's length transaction. The grocery store isn't making you a gift, even though it was buy one get one free. They're a business, they're just trying to make money. You're just trying to buy that good at the best price possible. Installment sale, this is where we've got that series of payments, so maybe monthly for your car or home. Exchange, we traded the boat for the car. We can do this with loved ones, so the private annuity and the self-counseling installment note. Here I'm doing this if I don't think I'm gonna live as long as the IRS life table thinks I'm going to live. I'm able to set this up as if that's all they're going to be paying. With the private annuity, their basis is however much they paid. So if I die 4 years later, they've only got 4 years worth of payments, that's their basis. With the self-counseling installment note, we agreed this asset was $1 million. They've only paid for 4 years, $400,000. Now they get the full million as their basis, even though they only paid $400,000. With the self-counseling installment note, the buyer is paying a premium, and that's what allows them to cancel it when I pass away. With the risk to the buyer, should medical technology, something come about where I'm going to live longer. Now, self-counseling installment note, we probably had a term on there of 20 years. I thought I was going to die in 10. It still ends at the 20 years, whatever we set up. With the private annuity, it would continue to pay me for as long as I was alive. So they'd be responsible for paying me. Risk to me, they stop paying me. So I've got that private annuity. My loved one is supposed to continue paying me, but they don't. And I have Alzheimer's, I'm in a nursing home. I just forget about it, don't realize that I should go after them. So somebody could take advantage of me that way. Grats and Gruts, this is that grantor retained trust, so annuity or income. Annuity, we determine what that payment will be when we create the trust. So it's based on the initial dollars I put in and what payment I think I should get. And I could make it high, I could make it low, but it's only valued once. I'll receive that same amount every year or every month for whatever the term of this is. With the GRIT, it's income, whatever income the trust generates. If it doesn't generate income one year, I'm not getting a payment. So that one's going to likely vary, where the GRAT's going to be the same every year. GRUT we don't want, that's the unit trust that we have to revalue every year, and we have to pay somebody to come in and say what the December 31st value of the trust is, and then do another calculation to figure out what my annuity will be for that year. Why do we use trusts? Because we have some professionals in manage it for our children, for our loved ones, for ourselves, for whoever. It's also protecting us from lawsuits or from creditors coming after a daughter. It protects a daughter from being able to take dollars out to go buy drugs. I'm only setting this trust up to pay for the things I specifically say it can pay for, and I can put all sorts of qualifications on it. As long as it's not something illegal, like you have to commit a murder, I can put that string on there. I can say you must be a full-time student, you must earn a certain GPA. This only lasts until you're a certain age. It can only be used for graduate school or undergraduate school or whatever different things I want to put on there. Most of the time you'll see those ascertainable standards set out as health, education, maintenance, and support. The HIMSS, health and education, very easy to see. This is a medical cost, this is an education cost. Maintenance and support can vary, and that's where you might get some arguments. If I have multiple people where 4 of my kids don't want to run the farm, 1 does, but I don't want to cut the others out, so here's this trust that owns the farm, that 1 kid is working it, maybe they get a larger share, I can set it up different ways. I'm getting it away from probate. So the living trust, meaning I created it inter vivos while I was alive, becomes irrevocable once I pass away. Or I can make it while I'm alive, inter vivos, irrevocable. What I put in there, I'm getting that appreciation out of my estate. Assuming I've set it up where it wasn't that intentionally defective grantor trust. So now I have the ability to change something in the trust, the beneficiary, the investments, anything else like that where I'm paying taxes out of my pocket. It's intentionally defective, I wanted that to happen. So I talked about the revocable and irrevocable. Testamentary, I created in my will. So it doesn't exist until I pass away. A lot of times I won't fund the trust until I pass away. Maybe the life insurance beneficiary designation is the trust. That could be that island. Forever trust can also be coming from life insurance or from something else. Unfunded, I might get mad at Billy and Susie and never fund it. Honorary or purposes tends to be for pets, to take care of them. Trusts are confidential. They're going to be controlled by whatever state they're living in. So we talk about dynasty trusts that we want to live in perpetuity for generations. I want to live in a state that doesn't have a rule against perpetuities. Completed gift for the irrevocable but not the revocable because I can change it at any time. Whereas the ILIT, with those life insurance trusts, I want them to have the ability to lend money to the estate or purchase assets from the estate, but I don't want to require that. If I require it, that is going to be included in the gross estate. These Q-tip would be for specific property. Grantor we talked about. These ones tend to be for self-qualified personal residence and tangible personal property. I get to stay in the home for the next 10 years, and then it goes to children. If I die during the term of that or the tangible personal property, same thing, but except for art, something else, it's included in my gross estate. All right, I can keep going. Class is over, but I'll just keep talking about these. The eventually effective, I maintain some sort of power over the trust, where I can revoke it, I can change the investments, I can change the beneficiaries, something like that, that makes it effective, so I'm continuing to pay taxes out of my own pocket. I mentioned the trust for minors. The 2503C, I said you could accumulate, but now they can take all of it at age 21. For the 2503B, I distribute every year. 2503C, accumulate. That's how I remember the C's in accumulate, B for distribute. Charitable trusts we'll get into later. We talked some about those. The Taunton Trust is really just a beneficiary designation on a bank account. Blind trust for the politician that doesn't want to have a conflict of interest when they draft legislation or do anything like that. Special needs trust, we can make those pooled. We can have it for the individual. It can be created by myself. So 3 different ways we can have a special needs trust. The idea being I don't want to reduce or infringe upon government entitlements. All right, that was a lot. Next time I will start with the later chapters. Any questions? All right, so there are study guides in the Blackboard Learning Tools folder, along with these slides, and you have access to the previous recordings. Real time.